Hi, it's Dre Griggs of the Obsidian Wisdom. Today we'll be answering the question, how does investing work? When it comes to investing, if you start high level, investing at the end of the day is your ability to choose a stock, to choose a company that you're going to buy at a price that is lower than the price you will sell it at. When you think about how investing works, that is the nuts and the bolts of it. If you are able to buy a stock for a price lower than you sell it at, then you are an investing genius and success is around the corner. The difficulty that we face is it's not always easy to find the stock with the lowest price, and then we're able to sell it in the future for a much higher price. We need so much information, and there's an abundance of information, but it always seems like there's not enough information, maybe not the right information. What ratios do you use when determining a company? How much about past performance should you be paying attention to? Should you try to find a company on its IPO because you feel like that's going to be a great price, that it's only going to go up? Everybody says the stock market is going up, historically speaking. So if I choose this one company, then it should go up at some point in time. But when it comes to investing, that is not always the case. Yes, the stock market tends to go up historically each year, but it doesn't mean every investment, especially the ones that we choose in our portfolio, are necessarily going to go up each year. When it comes to determining how investing works, there are three things you will need to do to be successful. The first is you have to be able to choose the right companies. Whatever that methodology is, valuing a stock is going to be the most important aspect of your investment strategy. If you're able to find a stock at a price that you're able to sell it much higher in the future, that is going to lead to success. On the back end of that, you have to figure out what the tax implications of your certain investments are. Second, we need to know how to construct our portfolio. When you're constructing a portfolio, you need to know whether you want to invest in stocks or bonds. You need to know what type of bonds. Every bond is not the same, whether you have a treasury bond versus a municipal bond. They are treated differently. Same when it comes to investing in stocks. Are you going to focus on a particular industry because you're very confident and comfortable in that industry? Or are you going to diversify across a wide sector? Or are you just going to pick the stocks that you feel are going to give you the highest return in the shortest amount of time? Investing works best if you know what your goal is. Is your goal to save for your kids' college or for your retirement? In those cases, you'll have a lot more time to have your money in the market, and then you're able to make different decisions on what you invest in. You can focus on growth because you have the time in case you have the losses to recoup those losses. But if you're investing in the stock market because you want some extra money for the down payment of your home, well, in that case, you need the money, one, in a shorter amount of time, and two, you don't have the ability to lose the money. This money is needed, so you won't be able to focus as much on growth as you may focus on capital preservation, which is a very fancy way of just saying, I need to make sure my money is there. And I don't want my money to go down very much. There is no magic bullet. Investing works differently for each of us depending on what our goal is, what the money needs to do, and how long we have to wait, which some will call a time horizon, and what type of investments that we're going to take on. Are we going to take on heavier risk investments because there's a chance we may win very big? There's a chance we may lose very big. Are we going to leave our money in a wide range of stocks, or are we just going to choose a couple of stocks? Are we going to invest all of our money up front, or are we going to do what's called dollar cost averaging? You're going to put in a certain amount of money every single month over a period of 6 months or a year because you're not very confident in whether the stock is going to go up or down in the near future. So even though we all have the same goal, and the idea of investing is I buy a stock at a lower price than I sell it, if you had $10,000 to invest in 2010 and you had to choose between Tesla and Molly Corp, knowing what you know today, you would probably choose Tesla. But did you know in 2010, Tesla opened at $17 a share and it went down. It actually lost money in that first year. On the other hand, Molly Corp on its first year opened at $14 and it went up to about $49.50, which would have been about a 256% increase. If you would have left that $10,000 in Tesla, today Tesla is about $930. So your $10,000 would have turned into about $550,000 between 2010, about June 2010, to August 2022. 12 years, not bad, $550,000. If you would have chosen Molly Corp, which was about a month later in July of 2010, Even though you had a 256% increase by the end of that first year, in 2015, Molycorp actually filed for bankruptcy. If you invested $10,000 in Molycorp in 2010, you would have a whopping $0 in 2022. That is the difficulty that we find when it comes to investing. There is no guaranteed approach. There's definitely no guaranteed result. You would look at the two companies and you would say, okay, one's going down in the beginning, so I don't want to invest in that one, while the other one is skyrocketing, 256% increase, and they ended up filing for bankruptcy. Now, for those who are wondering, Molycorp was a company that had a mine out in California, and they were mining different minerals, and they were very successful in the early going. Rare minerals, because they're so difficult to mine, are actually very valuable. We use them in most of our technology, and so it was a very successful and a pretty good choice if you understand that industry. But there were some things that changed from a competitive nature and the accessibility of their mine, where they ended up losing everything. Tesla, on the other hand, we understand they've been around for a while, and the change of leadership and a change in the overall market, we've seen where electric vehicles have become a very big deal, especially if you take into consideration the regulations just passed by Congress, where Tesla has a very nice bump because there's now subsidies to encourage people to buy electric vehicles. Tesla, being one of the market movers and shakers of the electric automobile, they've positioned themselves very nicely, where you have this ability, if the regulations in a certain environment, if they change, where it can move towards your investment or it can move away from your investment. So when it comes to what investing really is as simple as choosing a company at a lower price that I plan on selling it. But the difficulty becomes, how do I know which company to choose and how do I value the company? Even if I do that right, which is not a guarantee, how do I know that my company will maintain its value throughout the entire investment process? In investing, you ultimately have to decide, which sectors am I going to invest in? How much am I going to invest? What frequency am I going to invest? And how long am I going to invest? If you're able to answer these questions, then you have a pretty good framework to understanding what and how investing works. But there is no guarantee. So if you're going to choose individual companies, you have to stay on top of them. You need to follow them in the news. You have to see if there's different laws that are going to be passed and where the overall consumer sentiment is going when you're deciding whether your investment will have continued success. For those who aren't interested in choosing their own portfolio and keeping up with their investments, there are different options out there where you can invest with different mutual funds or ETFs or index funds, where there's different fees because of how active or passive the investments are, but you're able to choose another company who is going to follow the market for you. Now, you have to do your research on who to choose, and you have to keep up with the money market manager, but that won't require as much. But you do want to keep up with how they're performing, what they're investing in, and whether the same fund managers are continuing to choose the asset allocations. You'll need to keep up with that. You also got to keep up with the fees and whether there's any hidden fees, because the percentages, while they may be small, they do add up and they do have an impact on your performance if you're talking about a decade or two or even 3 decades of investing with someone. So you do want to keep up with the overall fees, but it's a much more manageable approach. If you want the most affordable route, then index funds, which are considered passive investments, usually work pretty well for people. They simply match the S&P 500 or the New York Stock Exchange, so you don't have to worry about paying them an active fee because they're not actively managing the money. They simply are going to mirror the market, and then the money that you get should be somewhere in line with the market. That works for some people as well. At the end of the day, investing is about making choices. You choose whether you spend or save your money, and for the money that you save, you choose whether you want to invest it or whether you want to leave it in a savings account, whether you want to put it in the stock market or whether you want to use it to start a business or whether you want to use it to invest in real estate. You have a choice what to do with the money that you are saving. And if you choose to put your money in the stock market, you have to understand how to buy and sell securities, how to value those securities, and how to construct your portfolio to achieve your financial goals. If you like the video, I ask you to like and subscribe, and feel free to check out other Wisdometric videos if you're looking for ways to eradicate financial stress, generate passive income, and build a prosperous retirement strategy.